Welcome to the second installment of FinTech Talk series hosted by the FinTech Sandbox. I'm Debarshi Nandi, the Barbara and Richard M. Rosenberg Professor of Global Finance at Brandeis University's International Business School, and it's my pleasure to introduce today's session on financial services, shifting center on ESG. The focus of financial services on ESG and impact investing is particularly relevant and to the core values of Brandeis University that focuses on social justice, equality, and inclusion globally. Financial services is critical for our continued progress and growth in all dimensions, and it is therefore very important to understand and shape the role of financial services such that it ensures inclusive global growth. And that's why I am very excited to listen to this discussion this afternoon. In addition to this discussion, we have several other discussions later on. This afternoon, you can also attend Can You Actually Do Well by Doing Good? A look at incentivizing VCs to invest in financial inclusion companies. At 3 p.m. and tomorrow at noon, we have a session on financial products from the gig economy. And with that, I'm excited to welcome Carol Caruso from Bloom Impact to get us started with Financial Services Shifting Center on ESG session. Hope you enjoy the conversation. Thank you.
Great. Thanks to Barshi for that great introduction, and welcome everyone. Thanks for joining us this week for FinTech Talks, hosted by FinTech Sandbox. As Debarshi mentioned, I'm Carol Caruso. I'm the CEO and co-founder of a social enterprise called Bloom Impact, which is a FinTech marketplace for small businesses in Africa. In our session today, we'll be talking with an experienced lineup of speakers about ESG and how financial services is shifting both its technology and its investment strategies to match market interest. So I prepared a couple of questions for our discussion today, and we'll also be doing some Q&A with the audience. So if you would like to submit questions, do certainly use the Q&A box on your screen, and we will be going through that. There's also a chat box, so feel free to jump in and chat amongst yourselves and introduce yourselves, but do certainly reserve any of your questions for the Q&A box, because that's all we'll be able to have access to as panelists. Great, so let's jump in and talk about ESG in terms of the societal impact, so environmental, social, and governance criteria. Our standards for a company's operations and socially conscious investors use to screen potential investments. But the S is often considered the most difficult area of the big three in ESG to quantify. Especially in terms of financial services, inclusive finance. And so each of the panelists today, they're approaching the topic from quite a unique vantage point. They each offer a unique perspective on the opportunities and the challenges that we're seeing, especially with regards to availability of data, the technology, and the standards in order to drive outcomes through FinTech. So I'm going to start by introducing everyone, because we do have quite an esteemed panel. We'll start with Hideki. Hideki joined us from Manulife. He's part of a global team that approaches sustainable investing by taking a macro perspective look on ESG risks, combined with local market expertise. And he leads Manulife's ESG data methodology and analytics development efforts and considers this hairy topic through a unique lens of data, tech, and investing. John from Franklin Templeton, he's leading the integration of impact investing into new products and strategies, and by overseeing the integration of impact assessment into existing investment processes. His current remit is leading their social infrastructure strategy, such as investments in hospitals and clinics, schools, universities, affordable housing. And so it's really giving them a front row seat to how institutional investors are leveraging capital markets capabilities to tackle important societal challenges on Main Street. And Larry, he's been looking at ESG for well over a decade, and brings a breadth of experience and insight to his leadership role at MSCI. arguably MSCI is a leader, providing ESG data in the market today. And Larry oversees the product management of MSCI's ESG fund ratings, ESG data, and ESG client-facing platforms for institutional investors and private wealth managers. And Paul from Algorand, he's bringing quite a vision to our panel in terms of what the future looks like for inclusive financial services, and especially as it relates to the S in ESG. Paul is Algorand's Chief Product Officer and quite instrumental in the strategy, the build, and the deployment of blockchain capability that can be used by many companies in terms of transforming lives of individuals. For example, something really neat that Algorand worked on was with the Asia Reserve Currency coin, the ARC. And the ARC is designed to be the world's first micro asset, and it's enabling financial inclusion in the urban working poor class in Southeast Asia. So, their technology is really expanding the capabilities of financial services to tackle societal challenges. So that's our esteemed panel that is bringing these unique perspectives from all those experiences. And we're going to jump in and talk about our first question, which is, as we look at the societal impacts with ESG, particularly around inclusivity and income inequality, such as financial services, et cetera, as part of your work, your ESG work, I'd like to talk about how you're including social standards in your work. Why don't we start with that? We can start with you, Hideki, and talking about how you're incorporating this, and also if you can talk about what you're seeing with investor demand in terms of what you're seeing with growth and interest from investors.
Hi, thank you so much, Carol. Can you hear me okay?
Yes, thank you.
Okay, great. Yeah, so I think in terms of the social data indicators that we look at, so as you noted, I think S is harder than the E in terms of being able to quantify. However, companies are stepping up, and then there's a lot of data sets that are coming out in terms of companies' operational, social work that they're doing in terms of employee equity, diversity, and inclusion, for example. But if we were to sort of focus on the financial services, so we look at social impact data sets from companies' products and services perspective. So when we look at banks, for example, it would be SME lending, microcredit, microloans. So those type of products, if the companies have those, then we look at that. But we don't actually sort of stop here. And we actually look at other variety of things that are sort of related to the products and services that they offer. For example, we think that education is a very important indicator for addressing social equity. So we think that the people are sort of trapped in this vicious circle around skills and wages. And when you work long hours that pay you less, you can't really pay to build skills or have the time to. So that is why it's important to look at sort of holistic diversity, equity, and inclusion performance of investee companies. That includes pay equity, education trainings, upward mobility, etc. So if we are talking about banks specifically, they ought to be offering financial literacy training, for example.
Great. Yeah, no, those are really good points. It's good to know that you're really deeply looking at those products and services to see, just how much they are implementing in terms of the societal impacts versus traditional products and services. How about you, John? Maybe you can speak more to the demand side of this question.
Sure. Thanks, Carol. So yeah, I'm coming at this from the perspective of an impact investor. So our investors want a dual return, these reinforcing returns, a financial return as well as a societal or environmental improvement as a part of our investments. And demand for this type of investing is skyrocketing, which is really exciting. And it's born from, it's actually intuitive. If you think of us all as consumers, we want to know what's in our food. We want to know where our clothes are made. And so now people want to know what their money is doing out in society. And that's led to more transparency. And with that transparency, now there's this awareness of what our money is doing out in the world, which means a lot of social-minded investors want their money to do more. And this is leading not only more to impact investing, it's also raising the bar for having to prove impact. And so it's leading us to have to do more backed by logic models. We don't want to just talk about what feels good. We want to talk about real good. We want to show that through our investments, through supporting companies, entrepreneurs, many of which are hopefully listening today, that we're actually creating a better outcome than what would have happened without it. And in this case, this is the social side is really about empowerment. I agree with Hideki. Education and financial inclusion is an empowerment concept. It's this idea, you don't need charity, you need to let people build themselves up, and being part of the financial ecosystem is really important, an important way to do that. And so we're seeing demand for this, and we're seeing a lot of proof that you in fact can have profit with purpose.
Yeah, great. No, those are really good points, John. Absolutely. I think as investors are looking to make more conscious investment decisions, they're going to need a lot of that kind of data, that kind of transparency in order to make these decisions and feel comfortable with where they're putting their money. I'd love to segue over to Larry and hear your thoughts on that. Obviously, MSSI, you really are focused on this as well in terms of bringing up that data to provide that kind of transparency. Can you talk a bit more about in your work, where the social is coming into some of your day-to-day activities and the work that you guys are providing into the sector?
No, absolutely. I think just to add on and add something sort of unique to the discussion, at MSCI, our goal is to help investors build better portfolios, but also provide them the data analytics to evaluate their portfolios, but also to report and measure progress. And be, having been in the ESG industry for over 20 years, I've seen things change quite a bit. And what we've been focused on as of late, especially, has been helping our clients and investors understand, the not only the impact of their portfolios, but the performance of their portfolios as it relates to ESG. Now, the S in ESG has been a tricky subject for a lot of people, especially we're seeing social issues like inequality. It's no longer in the background of our lives, right? It's pretty in your face every day now. And the trend we're seeing is that, the private sector, companies, investors, allocators are reacting and they're responding to this. Just as one example, historically, it's been a struggle with social issues more because they're harder to measure, they're harder to link to company performance compared to sort of E and G in the ESG spectrum. And what our research is seeing is that S, the social in ESG, is now a very prominent systemic risk factor. Social issues are in fact material issues that can have a material impact on a company's performance. In recent research, for example, we found that when companies have governance-related problems, these problems tend to materialize in negative events like ethics scandals that, precipitate major stock price drawdowns. In contrast, environmental risk management or poor environmental risk management don't tend to impact companies in these dramatic episodes. Instead, you see these effects in a gradual erosion year after year or year over year of competitiveness and lower stock price value over time. Now, in contrast, what we've seen is that social issues can actually hit you from both sides. They can hit you by periodic negative events like lawsuits, strikes. Plus, in the background, there is a gradual erosion of productivity, stifled innovation, and in our analysis has shown that that this has led to lower profitability and stock price value over time.
Yeah, Absolutely. I'm wondering, for sure, we're all excited to see that the demand has been increasing, as also you mentioned. Can you provide a couple of specific examples about how some clients of yours are putting portfolios together? What specific data are they looking for to be able to measure this and feel it a little bit more tangibly?
Yeah, no, that's a great question. So there are a few things we can focus on. One, we've seen a lot of interest in clients trying to align their portfolios with the UN Sustainable Development Goals, these 17 major societal issues that we've come together as a group of countries and said we need to solve these societal issues over the coming decades. So that's been a focus of many of our clients. The other area is around diversity and inclusion, and that's been an area where we've met with, a number of our large clients that represent trillions of dollars in assets under management that have expressed interest in us making more and more data available around the workforce diversity of the companies that they invest in, so that they have more details about what's in their portfolios, what they own, around the diversity of the board of those companies, also around the practices of those companies. Do they have retention strategies? Do they have long-term incentive strategies? What is their attrition rate? And what is the what is the percentage of employees, incoming employees that are diverse, and are D&I structures or goals tied to executive compensation, for example? So that's just one area where we're making lots of inroads and efforts to make more data available. In fact, we're introducing sometime over the next few months, we'll be introducing our diversity data set across companies in the U.S., driven by investor demand for this type of thing. The other area is, moving away from less the companies, but thinking about the allocators. Allocators are very focused on this as well. If you look at the $70 or so trillion being managed in the U.S., only 1.3% of that is managed by women or minority-owned firms. And there's this clear interest by allocators to allocate to more diverse firms, more diverse investment managers, and that's certainly a trend I don't think we'll see stop.
Okay. Yeah, absolutely. Yeah, there's definitely more demand, especially in women-owned businesses and how they're supporting, women entrepreneurs, for example. So yeah, that's really a really important space. You bring up a good point in terms of, being able to obtain the data and getting the information from some of the companies that you're analyzing. So I'd love to move on to this second question around transparency. That's definitely one of the constraints that a lot of folks speak about in the sector. Transparency and the ability to obtain data is really a growing demand. So can you talk, I'd like to throw this to all the panelists, about what indicators are you looking at? What kind of data and how are you measuring this impact? When you're getting the data, how are you able to put some measures against this as you're helping clients put portfolios together? And also, I'd love to bring Paul into the discussion to talk about what are we looking at with new technologies such as blockchain that are allowing us to be more transparent in order to measure this data, obtain the data first of all, and be able to measure and share it transparently. So why don't I throw it out to you, Paul?
Yeah, happy to jump in on that. I think what's most interesting about blockchain as it relates to ESG is fundamentally the ethos is exactly the same. What is blockchain trying to do? It's trying to increase transparency, auditability, inclusiveness, ownership, all of the things. It's trying to make a difference in how the world operates. Now, oftentimes as it relates to financial value creation and exchange, but it really aligns well with the overall ethos. And so it shows up in a couple of different areas. The first one, I think it was John that was talking about provability. And blockchain provides sort of underlying tech that helps put the data out there in a transparent, auditable, immutable way, where everyone can see the data, understand where it came from, and it's programmatic, and it's can be trusted in that kind of way. The other way that we see this showing up is specifically with the entrepreneurs themselves and the folks that are building these companies that have sort of an ESG underlying focus. And it's because, in the sort of traditional tech stack space, you end up seeing these companies oftentimes sort of fighting with their tech stack. They want to be inclusive. They want to do things like have transparency. They want to be able to fractionalize ownership so they can reach more markets. But the underlying tech stack sometimes, often doesn't support it, and sometimes actively doesn't support it. And so they have to do all sorts of funny things, whether it's with business processes, et cetera, to try and support their underlying goals. And so by having blockchain in the stack, they can support, provability and traceability of where these items have been, where they've come from. They can support fractionalization of taking very small pieces of ownership. You mentioned ARCC, which is a financial inclusion tool in Southeast Asia. They can support tokenization and create secondary markets to sort of increase the overall impact of what they're doing. So, for example, there's a company called Planet Watch, which is the first blockchain spinoff out of CERN in Switzerland. They're doing air quality monitoring. They're putting all that data on the blockchain where it's accessible to everyone and they can see it. Climate Trade is a blockchain-based marketplace for CO2 carbon offsetting. And the tokenization and the underlying platform allows them to scale, allows them to have this really interesting peer-to-peer model at scale that is really hard to do without blockchain. These are environmental examples, but I think at the base, you really see a really interesting crossover between blockchain and ESG, and it's really bringing a lot of these entrepreneurs to look at how they can include blockchain in their stack to amplify what they're trying to do, not just to be part of their tech stack and enable.
Yeah, absolutely. Definitely using blockchain as a core, for the foundation of the technology is certainly going to blow it wide open in terms of allowing accessibility and transparency to that data. I'm curious to hear what the rest of the panelists think. Larry, Hideki, John, in your work, to what extent are you looking at blockchain companies, or companies using blockchain as a form of data gathering and being able to measure impact?
Yeah, maybe I make a quick comment on that. I mean, where we sit, nothing is ever off the table because we're pretty forward-looking in terms of how we go about doing our work and continuing to deliver for our clients. But one of the things, again, I've been doing this for a long time, and we've seen some seismic changes in how we collect and go retrieve data. If you look back 10, 15 years ago, if you think about how data was collected, and this is sort of not traditional financial data that's available everywhere. This is sort of, ESG data that's typically considered non-standard, that you need to go search and dig for. You had an analyst who used to sort of sit at their computer. They went to a company's website, downloaded the data they needed, go to a government website, downloaded whatever 10Ks they needed, read it, copy pasted the relevant information from that, populated a database, and you were able to use that. We've gone so far from that world where today we're using different technologies from and everything from machine learning, natural language processing, even artificial intelligence to help us go out, get this information, automatically synthesize it in our database, taking unstructured data, structuring all of that, really scouring these thousands of data sources that we have, and then making use of that and using our methodologies and models to really synthesize it in a way that's sort of understandable to our clients. Now, one of the big misconceptions that many people who look at sort of ESG or sustainable investing for the first time, the big misconception they have is that the information is typically comes directly from the companies. Companies tell us what they have, and therefore the companies who tell us the most are the ones who get the best scores or are rated highly in our models, and that's simply not the case. As an example, only 45% of the data that we use in our models come from alternative data sets, including, specialized regulatory agencies, academic institution, NGO databases, over 3,000 global and local news sources. So the one of the trends we've seen or why adoption has grown so much and there's been so much focus on sustainable investing is people, investors have become more comfortable with the state of the data, the quality of the data, and how we're able to deliver that to them and make sense of it for them and provide the insights.
Yeah, thanks for that, Larry. But on that point, I'm wondering, to what extent are you pulling data from APIs versus constantly going out and trying to, pull it from individual companies? Are there particular reporting agencies that you guys use where you're pulling some of the data? Can you give us an idea of, what is the percentage of each, in terms of, you're mostly trying to pull and drag and only 20% of it are APIs you can tap into? And along the lines of this question, where might you see some opportunities in terms of that data gathering and deploying, more technology to gather that data and to measure it in more sophisticated ways?
Yeah, no, I mean, everything from, geographic maps to databases around where certain water basins are. So that's just one example. We've also looked at collecting the carbon emissions of every facility in the US, for example, and then mapping that back to companies, both public and private. So it's, if you're in the business of going directly to companies and that's your only method of getting data, you won't be successful long term. It's just the industry's moved on too far. You need to look at alternative data sources. So that's just one example. I would say about 20% of the information we get comes from mandatory company disclosure. So companies have to do this stuff. So we look at those regulatory reporting. And it's not just someone going in and sort of looking at something and pulling the data. We've built out the mechanisms, as you said, the APIs into different databases to get that information directly to us, whether it be information from the CDP or different governmental agencies. So that's one thing. About 30% comes from voluntary company disclosures, things companies provide to us. And then again, 45% from alternative data sources. Now, the other big way we've leveraged technology is building an ecosystem for the companies that are in our databases. Now, we've leveraged technology to go from providing data on about 1,200 companies 15 years ago to today. We can give you information for over 15,000 companies, issuers globally, mapping it to over 600,000 different fixed income and equity securities. So it's really transformed how we do things, and so that's been a huge benefit. But the other way we've leveraged it is we've built a platform and an ecosystem, what we call our issuer portal, where companies are able to go. We send companies information that we've collected on them as a verification process. They're able to go and verify that information, look at that information, ask questions about it. And help us sort of synthesize all of that. So technology is certainly at the core of everything we do there. It's the only reason we've been able to scale and cover more and more of our client portfolios. And I think to be successful in this, you need to cover the full portfolio. Otherwise, doing impact reporting and impact measurements is going to be hard just on a partial portion of your portfolio.
If I can add here, Carol, so I think this is all really important to think about. The data, validating the data, democratizing data, but also we need to put data in some sort of context. I think we often talk about it's not just impact and measurement, it's impact measurement and management. And so if for instance, we invest in a school and we tell you, how many kids were educated, what are you going to do with that number? Should it have been more? Should it have been less? How do you know how to compare that data? And so it all has to fit into an overall system for how to measure and manage impact. And for us, that starts with a theory of change, which is this idea of, okay, let's take a step back. What is the challenge that you're trying to address? First we have to start with that. And then what are you doing to contribute to solutions? And then the data is the proof point. The data then is what ties it back to prove that you've done it. And I would encourage anyone who has a social mission built into their business, write out your theory of change, because there's so many different ways to do good, so many ways to map our activities. It's really important to say, this is where we're intentionally contributing to a certain challenge. And the whole system of measurement and management, we talk about the 5 building blocks. There's no one simple tool to do this. There's objectives like the Sustainable Development Goals. There's standards, certifications, different methods, and then metrics as well. And I know one of the questions in the chat box was, how do you do all this? It starts with those Sustainable Development Goals. It's the theory of change. There's also a great organization called the Impact Management Project that talks about the 5 dimensions of impact. You need to talk about what is the impact, who are the beneficiaries, how much, and then also what are the risks. Impact, we often talk about it like it's a given, but we need to think of it just like we would a financial return. There are risks, there are impediments to impact as well. And so we need to build all of this into a holistic, I keep saying logic model or a theory of change. And I think the role of blockchain and data really comes in throughout, but also primarily at the end to validate what we're doing. And we're beneficiaries of that technology. We're not using blockchain directly, but we would benefit from things like better data on grid energy and where it's coming from. And as that gets more put on the chain, we then can make better decisions about how to improve our investments and our properties, where to engage, et cetera. So just wanted to add that it's this whole ecosystem to how to manage and measure impact, not just measure it ex post.
Yeah. Those are really good points, John. I just wanted to add in here, both you and Larry talking about the importance of being able to gather that data so that you can therefore produce the reporting that's used for investment decision. To your point, for entrepreneurs and social enterprises, it's also pretty critical that we see more support for these enterprises in terms of them being able to put the monitoring and evaluation in place in the first place for them to even produce that kind of data. So there's also this front end constraint in trying to get that data compiled and then also reporting it. I think anyone who is a B Corp with the B Lab, they have a very good reporting mechanism and some really good standards around helping companies think through what they need to be monitoring. If their theory of change includes some sort of specific societal impact, how are they measuring that? How frequently are they measuring that? What are they measuring that up against? And then how frequently can they report it? So I think we also need to start that far down in the value chain with companies who are out on the front lines and helping them figure out how to report. So folks like you have that data to then compile, so the investors have even richer data sets to make some of these decisions. Hideki, did you want to add here from your perspective?
Yes, yeah. Thanks, Carol, for the comment. And I just wanted to echo what John was saying about the impact, because the quantified data that could get you only so far in terms of looking at companies' intentionality. And as active managers, what we have to do is by looking at the numbers, and you actually really have to look under the hood and then say, okay, so are the companies being intentional in terms of servicing, providing service to underserved communities, for example? And it happens a lot, like around, let's say, education services, right? From the look of it, it looks great. They're providing education to the masses, but that could potentially be creating a more social divide, because what if it's a private tutoring service that's really expensive? Only the wealthy can afford that service. Are they providing, lower tier, pricing service, for example? So you really have to look and then see companies' intentionality, and then, how much of an impact the company is trying to make to serve the underserved community. And because there's a lot of, greenwashing that's happening in the industry. So I think being able to decipher and then, be able to differentiate companies that are doing this as a BAU, business as usual, versus, they're actually trying to make specific impact.
Yeah, you bring up greenwashing. How do you suggest we can guard against that?
Yeah, I've got a few thoughts on that. I mean, I think it really is transparency and authenticity. It's really about being clear what you can do, but also what you can't do. Mm-hmm. So sometimes we see, for instance, we are in real estate from an impact investor perspective. If we purchase a hospital and report lives saved, that's a bit disingenuous. We didn't save the lives. The nurses, the doctors did. We have to be very clear about the role our capital plays. And that's what this whole conversation is about. It's about proving it. It's linking, follow the money, follow the actions, and back it with research and data to prove that what you've done has led to a better result. Now, proof is the goal. It's not always where we get. You can't always prove a counterfactual. You can't always prove that it wouldn't have happened without you. But that's what we always strive to do. And the more we have access to good quality data, and the more we link that to research, the more we can separate those greenwashing from those who aren't.
Yeah, and I think John and Decky make some great points. I think it's a combination of looking at the outcome, the actual outcome, as well as the intention and what they're saying, and sort of putting those two together and seeing, I mean, are they achieving what they say they're achieving, and is what they're achieving through reporting, measurements, and analytics, which is what we really help clients with. Does that fit with what we aim to achieve? And I think a lot of times, especially in sort of the wealth management segment, is more as ESG becomes more democratized and technology is making it more accessible to those individual investors. I think it's going to become more and more important to understand as a person, as an individual, but also as an institution, what are we trying to accomplish? What are the areas we want to focus on? What are our goals? And then overlaying those goals with the outcomes, as well as the analytics to understand whether or not they're helping you achieve those.
Yeah, absolutely. Sure, go ahead.
Sorry, Carol. Yeah, if I were to add what Larry was saying and also what Paul mentioned, I think technology has a potential to play a huge role in this outcome measurement, because Paul talked about the auditability, traceability of the data, for example, and then we could actually see, well, this actually came out from company's press release, so this is sort of more of like a marketing impact than the actual source that's coming from people that are being helped. So something like that, I think the technology has a potential to help investment managers to be able to assess these outcome authenticity.
And do you see some gaps in that technology where you suggest there's some opportunities for the audience that might be listening?
Yeah, I mean, we have a huge desire to innovate at Manulife. We look at different technologies. We partner with, FinTech companies. But I think we are still at a nascent stage to be able to measure impact in that respect. So I think there's a lot of opportunity for the emerging companies to look at this.
So for you, Hideki, and the other panelists, can you talk a little bit more about that? Like, what kind of fintech companies are you partnering with, or where do you see some gaps where fintech companies can actually focus on development to help you in certain areas?
Yeah, I'm happy to. Sorry. Go ahead, Hideki.
So very quickly, Larry. From my perspective, a lot of the services that are out there, they focus on large cap equity space. There's a lot of tools out there to be able to get insight into multinational companies. There's just so little in terms of covering smaller companies, private companies, fixed income issuers that are private. So those areas, I think there's a huge opportunity.
Yeah, and I mean, I think we're still on the ground floor in terms of what could be achieved, especially with technology. I feel as though every time I look at the news, there's another fintech company popping up that's trying to solve for something. But I think where we see a lot of opportunity is around climate change. And a year and a half ago, we acquired a fintech firm called Carbon Delta, based in Zurich, and they specialized in helping understand what the climate value at risk of your portfolio and companies were, as in if depending on the different climate scenarios that might occur in the future, how much value might you lose in your portfolio is one impact of financial measure. They've also developed what we call is a warming potential, which helps you understand what temperature is a particular company that you're interested in investing in, or is your portfolio aligned with? Is it the 1.5 degree world scenario, which is where we all hope to accomplish and meet, or is it 3 or 4 degree? If those scenarios were to happen, lots of things, terrible things would happen, from sea level rising to terrible weather patterns and things like that, and as well as measuring sort of the physical risks, your exposure to physical risk based on where you operate, the types of businesses you're in. Are you susceptible to different weather disruptions, from flooding, storms and things like that? So I think there is a tremendous amount of opportunity to partner And we continue to partner with different fintech firms. And I think literally we're at the ground floor. There's so much opportunity not only to address these problems. Climate change is a very big subject right now, but I think you'll see more and more of these types of issues pop up, and lots of technology and fintech companies step up to start driving for solutions. And I think that solutions-oriented approach, if you think about where we are today with the Paris goals, as well as the Biden administration starting to commit to decarbonization, companies who are going to have to decarbonize their operations are going to look for solutions. And I think the fintech firms have a huge opportunity to help these companies who need to decarbonize their operations find different ways to do that, whether it's with technology and computers, servers, or just operational efficiencies and things like that.
Yeah, absolutely. I mean, there's certainly an unlimited amount in the environmental space in terms of how they can, help support, especially on their analytics and the reporting on that. But I'm curious to hear from your perspective, Paul, just sort of circling back on the fintech space. Are there some examples that you can cite in terms of what you're working with some fintechs in terms of how they're deploying solutions for societal impact, whether it's inclusive finance or financial education and literacy, or driving better savings behavior related to leveraging blockchain and transparency with the work that you're doing?
Yeah, for sure. So we mentioned a couple things earlier. Planet Watch on the environmental side. So Planet Watch, Climate Trade, Global Carbon Holding. There are a number of companies that are using the blockchain to do things like offsetting carbon and making a peer-to-peer marketplace and expanding the ability for anybody to be included in that market, rather than very large companies or having a very high bar to being able to help out with those kinds of tokenized models. We also have a number of inclusive sort of financial projects as well. We talked about ARCC, which is creating very small fractionalized ownership in stocks for folks to be able to participate in the market at a level that they can participate in. At a sort of more macro level, one of the things that blockchain does is it allows people to participate in an inclusive financial environment without needing a bunch of the things that maybe block them from participating otherwise. In other words, I don't need to necessarily have a bank account. I don't necessarily need to have, 4 sets of ID and, the government issued this, that, and the other. You can participate with what you have, where you are, and participate at the highest level at really either creating these financial instruments or participating on the investment side, or just using it, for things like we talked about on the environmental side. I do want to address one thing. So I saw a question come through about the impact of blockchain on energy consumption. I think that's a sort of a good tie-in, because I'm talking about these environmental things, and then I'm sure some people are saying, hey, the underlying tech here is also an energy problem. And I'll come at that question from basically 2 angles. One, there are two categories of blockchains. There's what's called the proof of work blockchain, where you've got things called miners, and these miners are doing very computationally intensive things that uses and burns up a lot of the energy. And then there's proof of stake blockchains that are very, very light in terms of energy consumption. There's nothing special going on. I could be running it on my laptop here in front of me. And so Algorand is a proof of stake blockchain, which means we use very little energy relative to these very large proof of work blockchains like Bitcoin. But the other thing I'll say is the energy argument with blockchains, frankly, it lacks a lot of nuance. When you look at something like a Bitcoin, 40% of that energy is coming from renewable sources, and it's going up. There's also an argument of talking about, hey, what's the underlying value that this system is providing? When you look at something like a Bitcoin, you've got a global financial system with, I forget what it is now, trillion or something dollars that are riding on it. And if you compare sort of that system to other systems in the world, even silly systems like how much energy do we spend on dryers in the world, right? We don't think about it because it's sort of a longer stretch to make. Whereas the blockchain, it's so close. Energy production equals value creation for these miners. And so it's a really easy kind of system to look at. But I guess, so from a top level, again, Algorand is a proof of stake blockchain, doesn't use that kind of energy. But I also think the blockchain industry could benefit from a little bit more of a nuanced view on that in the rest of the world as you look at the impact of this system versus the value that it provides.
Right. In some ways, it's a little bit of an easy target to be able to correlate the impact there.
Exactly. Yeah.
Point taken. I just want to add on to something you brought up earlier, and I know a couple of audience members asked about this. In terms of leveraging Bitcoin and blockchain, particularly in emerging markets, there really is an interesting impact in how those solutions are really helping base of pyramid society in terms of being able to have access to payments, receiving and sending payments in a much more affordable and ease of use function. And I think that I'm not going to put anyone on the spot, but hopefully there's going to be a lot more demand and a lot more analytics on looking at companies like that who are bringing people into inclusive formal financial services with these types of innovative technologies, as you mentioned earlier, Paul. I want to bring into some audience questions. There's a lot of really interesting discussion going on to understand more about the reporting on this. We talked about earlier that the demand is increasing, which is fantastic, and there's more need for the data, and there's more need for the standardized reporting. What's happening related to, what do you guys think what's happening with the SEC, right? Calling for mandatory disclosures of, corporate political spending. If any of you can talk a little bit about that. maybe
from the Yeah, sure. I mean, I think from the ESG and sort of sustainability standpoint, I read a few things into it. One, our friends across the ocean in Europe and adjacent have been pretty far ahead of us in terms of ESG, and obviously the EU is put in place a number of mandatory regulations so that any financial institution operating or offering products to clients in the EU have to report around the sustainability criteria of their products, and those will sort of mature over time. I think what we'll see here in the U.S. with some of the announcements we've seen from the SEC with looking at auditing certain companies, and I think greenwashing is a few of the panelists have mentioned is going to be front and center, similar to what it is in the EU. So I think what you'll see, is the U.S. taking a playbook. This is my guess from the EU. To some extent, to sort of apply some of the same approaches they've applied there with mandatory disclosures. And over the years, I can also imagine us having there being audit and there being mandatory reporting of what your carbon footprint is and your decarbonization goals, both for public and private companies that operate within the U.S. as well. So I think seeing everything that's happening in the EU, I expect similar approaches to take place here. Climate is obviously a major focus, and I think that will dominate the subject for probably the better part of the year.
Yeah, I fully agree. It's going to continue to grow in terms of the interest and the demand, especially what we're seeing happening even in the U.S. with the new administration and some of the new initiatives that they're rolling out. John, Hideki, did you want to add anything on that point?
Yeah. So if I were to add on the regulatory front, places like SASB, Sustainability Accounting Standards Board, they've done significant work in terms of bringing a standardized ESG data set to the market, and they were actively approaching SEC to adopt in the past, and now given the change in administration, there's possibility that standards like SASB will be more widely accepted, and then when you look up some of the indicators that they have, especially around financial inclusions, for example, there are only 50 or so banks that are currently disclosing based on SASB, and there are 800 banks in the U.S. alone. So there's a significant gap here. And then, if the standardization happens, and then, I think more demand for, just like Larry was saying, carbon footprint could be mandatory. Some of the impact that the companies are making, that could be mandatory. So I think that's only going to sort of help us be able to assess, companies' ESG performance better.
Yeah, we definitely do need to see a lot more legislation to drive more of that monitoring and evaluation in the first place, and then the ability to report and the demand for that reporting. We only have a few minutes left, and I would love to jump into one last question here. Tying a lot of what we discussed together around the demand, the interest, and also the shortage, if you will, of data, and being able to get at that data and understand that data. I'd love for each of you to weigh in a bit about, why are we seeing so much difference among the ESG ratings? Can you talk a little bit about that and what we need to do to get a little bit more standardization, harmonization, so that investors and others in the sector can use this information more comparably and feel confident in the different rating information that's coming out and how they apply it? Maybe I can throw that out to you, John. Start with you.
Yeah, I'll be brief. I mean, I typically am dealing with private companies, but I think the issue here is that it's about data availability and comparability. And most of the data is self-reported. It's heavily delayed, and everyone is using different methodology. And also, when we take a step back, ESG is about good. That's a complicated concept. What is good? What's more important? The social, the environmental? Is it about waste and recycling? Is it about carbon emissions? There's so many different ways. And to actually take all that information and pull it into one number is a huge challenge. And I think, I'm sure Larry in particular can speak to this. I think that's why you're seeing really good companies come up with very different conclusions on the listed side. And again, on the private side, it becomes a bit more about not just measuring what you're doing intentionally, but also measuring all the negative externalities and having a focus on that. But I think we're far away from really having some universal way to compare data and come up with some objective number.
Yeah, and I can great points, John, and I can add to that. I think when you look at, ESG and sustainability, it's many ways an umbrella term. There's so many things that people shove into that. And we look at it and we segment it into three basic categories. There is the sort of values and individual objectives. I'm aiming to exclude certain types of investments from my portfolio, whether they be personal preferences, political preferences, religious preferences. So that's one way of addressing ESG. So understanding that objective is important. So that's one thing. The other is impact. We've talked a lot about impact, and that sort of is the combination of looking at both values and preferences and financial returns at the same time. The third bucket, and this is where we've seen the majority of the investment community sort of converge around ESG ratings and models, is about ESG integration. That is, how can we incorporate ESG to help us think about improving returns and mitigating risk? So ESG is a mechanism to help you measure, whether or not these types of ESG issues could have a material impact on the companies that you invest in. Are they aware and considering those ESG issues well enough? So I think that leads us into why these ratings, different ratings agencies differ, right? It's, as John said, fundamentally, the methodology and the approaches are different. At MSCI, we take, for our ESG ratings, we take a materiality first approach. And that is, we're not going to measure a bank on its water stress. We're going to measure beverage companies and companies that operate in that business on water stress and relevant issues. So I think materiality, as in relevant. Let's look at the issues that are relevant to the companies in the industries that they operate in, do a deep dive, and that's what their ratings are on. And that's our methodology applied. We were the first to sort of implement and launch a ratings model based on materiality, but the goal there is really about measuring how ESG issues could have a financial impact on the companies you invest in your portfolio as a whole. Mm-hmm.
And Carol, if I could add to that, so I think there's a misconception that people think that ESG ratings are like credit ratings. It's not, because ESG rating space, it's not regulated. Right. And from the user standpoint of view, having different views, that's not necessarily a bad thing. And then we think that, service providers, they're just like, sell-side research providers, right? They have different opinions about companies. So from that perspective, and especially in the active management space, and as an active manager, we use the service providers' ratings as a starting point. And then we try to understand, and we try to unpack and then see how this is rated as such. So that process is really important in understanding. So as long as you understand what went into that score, I think you can make sort of an informed decision based on that. And so the difference among the ESG ratings providers, it's not necessarily a concern.
Okay, great. No, it's good to hear your perspective on that, since you're deep in the weeds on it. And I think it makes a lot of sense, because we're not seeing any standardization in the methodology and the approach. Until we grow that awareness and there's more standardization, we will start to see some of those changes, and it is still unregulated, as you mentioned. We're at the top of the hour. I would just say in conclusion, this leads me, at least, and hopefully the audience, to believe that there's an incredible amount of opportunity still here in terms of being able to get some really important data out there, so that investors can start using it, and we can continue to see this growing demand for ESG investments, particularly in the societal impacts, and especially around equity and inclusive financial services, as this is a critical issue in the U.S. And abroad. So I want to thank all of the esteemed panelists. It was really, really cool to hear your perspective, since you're so deep in all of this. Thank you so much for all of your time.
Thank you.
Thanks,
everybody. Thank you so much.
Great. And for the audience, thanks so much for joining us. It was good to have your inputs and your questions. There are other FinTech Talk events coming up today at 3 p.m. about can you actually do well by doing good. And there's also the Boston FinTech Week in September. So certainly follow FinTech Sandbox and sign up for these, these discussions, because we're going to continue having discussions around the impact with ESG and other innovative topics around FinTech. So thanks for joining us.